It already happened. The breakout everyone is celebrating right now, that wasn't the beginning. It was the release. I stayed silent while the red candles printed, while timelines filled with frustration, while retail traders called it dead money and rotated into whatever was moving that week. I watched the order books thin out at 3 a.m. I watched liquidity pockets get tapped with surgical precision. And I noticed something most people didn't. The selling pressure wasn't aggressive, it was absorbed. XRP didn't collapse when it had every reason to. It compressed, it tightened, volatility shrank, exchange reserves quietly declined, funding rates stayed neutral, almost boring. That's not how panic looks, that's how positioning looks. And while retail debated headlines about the US Securities and Exchange Commission and speculated about the next move from Ripple Labs, something else was happening beneath the surface. Whale wallets were accumulating into weakness, not loudly, not recklessly, patiently. The breakout you're seeing now? It wasn't triggered by news, it was funded weeks ago, and once I show you what I saw, you'll realize the silence wasn't uncertainty, it was preparation. I remember the mood clearly: price drifting, volume fading, influencers losing conviction, every minor bounce getting sold. It felt like exhaustion, like XRP had no pulse left. But I don't trade emotion. I track structure. During those red weeks, something felt off. The drops were controlled, no cascading liquidations, no extreme funding spikes, no panic-driven blowouts, just steady pressure and equally steady absorption. Every dip into support was met with bids that didn't chase, they waited. That's when I started tracking exchange balances. XRP supply on exchanges wasn't rising during fear, it was shrinking. That's not distribution, that's inventory leaving the battlefield. And when inventory leaves exchanges during weakness, it usually means one thing: someone is preparing for strength. What really caught my attention were the wallet movements, large transfers, but not to exchanges, away from them. When whales plan to dump, they send tokens to liquidity hubs. When they plan to hold, they send them into cold storage. This wasn't chaotic movement, it was organized, timed around low volatility periods, executed during quiet weekends when retail engagement was minimal. That's not emotional trading, that's strategic positioning. And here's what most people missed: the accumulation wasn't aggressive enough to spike price. It was slow enough to avoid triggering momentum algorithms. They didn't want attention, they wanted inventory. And when smart money wants inventory, they create boredom, not excitement. While this was happening, the narrative was stuck on regulation. Every discussion circled back to the SEC case. Every price stall was blamed on uncertainty. Media framed XRP as still risky, but markets price risk before clarity. The moment regulatory tone shifts from hostility to structure, institutional comfort begins, even if headlines stay cautious. I noticed volatility compressing tighter after each legal development, not exploding. Compression after uncertainty often means the worst-case scenario is already discounted. And when fear is priced in quietly, relief rallies don't need dramatic announcements, they need positioning. At one point, the sell walls looked intimidating: thick liquidity stacked above price, enough to scare momentum traders away. But walls can be theater. I watched as price approached those levels repeatedly, and the walls dissolved just before impact, pulled, absorbed, shifted. That's not natural resistance, that's controlled liquidity management. When supply disappears right as demand tests it, someone is engineering the perception of weakness, and perception shapes retail behavior. Retail hesitates, smart money accumulates. If this were retail-driven hype, funding would have overheated. It didn't. Perpetual swaps stayed balanced, no extreme long bias, no crowded leverage. That told me something critical. This move wasn't fueled by gamblers, it was fueled by spot buyers. Spot-led breakouts are quieter at first, but structurally stronger. Because borrowed conviction collapses fast, owned conviction holds. When XRP finally broke resistance, it didn't explode vertically. It pushed, paused, retested, then held. The former ceiling became support. That's structural transition. Most retail traders expect fireworks. But real expansions often begin with quiet acceptance above reclaimed levels. That's not hype, that's control shifting sides. And once a key level flips, the psychology flips with it. Now I see the excitement returning. Timelines are louder, Thumbnails are brighter. The same voices that questioned survival are now declaring the start of the bull run. Conviction has been rediscovered, almost overnight. But I've been here long enough to recognize the pattern. Excitement doesn't mark the beginning of opportunity, it usually marks the end of asymmetry. Here's the uncomfortable truth: the low volatility accumulation phase, the boring weeks, the tight ranges, the fading engagement, that was the opportunity. That was when risk was compressed, when sellers were exhausted, when positioning could be built without competition. The breakout we're seeing now, that's validation, not invitation. Validation feels good, it feels safe, structure looks clean, momentum confirms the thesis. But safety in markets is rarely cheap. By the time optimism replaces doubt, early positioning is already complete. The inventory has already changed hands. When narratives shift from skepticism to enthusiasm, price has already traveled, the emotional discount is gone. What remains is momentum, and momentum is powerful, but it's also crowded. Smart money buys disbelief. They buy when sentiment is flat, when confidence is low, when patience is thin. They accumulate during silence because silence offers better pricing and less competition. Retail buys confirmation. Retail waits for proof, for headlines, for breakout candles that look real. But confirmation always costs more because it arrives after the risk-reward imbalance has shifted. That doesn't mean the move is over. It means the easy part might be. The question now isn't whether excitement is justified. It's whether you understand where you are in the cycle: accumulation, expansion, or euphoria. Because mistaking validation for opportunity is how traders end up funding the next distribution phase, and markets are ruthless with late conviction. I stayed silent because accumulation phases don't look exciting, they look frustrating. They look like nothing is happening. Price drifts sideways, volume dries up, social media engagement fades, influencers move on to louder charts, and the asset that once sparked emotion becomes boring. That boredom is the filter. Accumulation shakes out impatience. It punishes overleveraged traders. It exhausts the emotionally reactive. Every small dip feels like confirmation of failure. Every weak bounce feels like false hope. That's the environment smart money prefers. The whales didn't need headlines. They didn't need bullish predictions. They needed liquidity. And liquidity comes from doubt. It comes from tired holders pressing sell because it's not moving. It comes from traders rotating into whatever pumped last week. Emotionally exhausted sellers are the cleanest source of inventory. And once that inventory is absorbed, once supply transfers from weak hands to strong, expansion becomes easier, not guaranteed, but structurally supported. Because when price begins to rise and there's less overhead supply left to cap it, moves travel further with less resistance. Here's the warning: if you wait for clarity before positioning, you'll always be entering after the asymmetry is gone. Clarity is expensive, certainty costs premium prices. Watch exchange reserves. When they decline during boredom, pay attention. Watch volatility compression. When ranges tighten instead of collapsing, notice it. Watch structure, higher lows, reclaimed levels, shallow retracements. Ignore the noise. Because the next expansion won't start with applause. It won't feel safe. It will start with doubt, hesitation, and disbelief. And by the time the narrative flips, by the time headlines turn optimistic and confidence returns, the best prices will already belong to those who understood the silence wasn't weakness, it was preparation.